So welcome to the Toniic Global Webinar with a spotlight on our recently published report, T100 Insights from Impact Advisors and Consultants 2017. My name is Christian Siegel, the T100 Project Manager, and I will be your co-host along with Lisa Kleisner, co-writer and editor-in-chief of the T100 report. Thank you for joining us today, and thank you to our 6 guest speakers who we will introduce shortly. For those unfamiliar with Toniic, Toniic is the global community of individual investors, family offices, and foundations. Our members reside in over 20 countries, and they actively invest across asset classes and in diverse impact themes. Let's have a look what we will cover in the next hour. So for the next 35 minutes, we will explore the findings of the T100 Advisor Report, and throughout the presentation, hear from 6 expert impact advisors and consultants who participated in this report. We look forward to a lively and frank conversation. Thank you to the members in the audience who submitted questions in advance. We have incorporated these questions into the presentation and will invite our guest speakers to address them as we move through the slides. We will spend the last 20 minutes taking additional questions from the audience that were submitted through the Q&A tool to those who have actually logged in through their computers. So let's first have let's look on some technical notes. This webinar will be recorded and soon shared on the Toniic webpage. Please note that all audience members are muted. Questions can be directed through the Q&A tool in the webinar system located at the corner of your webinar window. Those dialing in from a phone line will actually not be able to submit questions nor see the slide presentation. So first of all, why T100? Advisors, researchers, and investors often cite the possibility of impact investing data, analysis, and stories as a hurdle to scaling impact investing. The T100 Project's goal is to contribute to a growing body of evidence in an effort to solve this problem. The T100 Project is enabled by Toniic 100% Impact Network members and their advisors who have generously opened their portfolios and shared their stories to help fill this gap. The Toniic 100% Impact Network members have committed to moving 100% of their assets of one portfolio into impact, and it is these portfolios that we are analyzing and sharing through the T100 Project. We have an ambitious multi-year longitudinal research objective, and we will soon announce a research partnership underwritten by foundation partners that will focus on both financial and behavior analysis of the aggregated data that we are collecting. Thanks to our members and their advisors, some of whom are on this call today. We started with the analysis of portfolios, and this work actually led to a development of the product and tool listed on this slide. For example, you can view personal impact journey videos and listen to podcasts of advisors. You can also use the Toniic directory to review over 1,000 investments across asset classes that are part of the T100 research. The recently released report and today's presentation focus on insights from 37 impact advisors and consultants who are supporting work in here. Supporting the 100% network members in their pursuit of a 100% impact portfolio. And for a look at the members who are behind the data, please check out the T100 launch report. All material produced by the T100 Project can be found on our webpage at toniic.com/T100. So let's have a quick look at today's audience. There are actually more women than men in the audience today. And while the attendees are primarily from North America, there are actually over 22 countries represented. About half of the audience is from the financial service industry, and a quarter are investors, and the remainder is made up of researchers, students, and entrepreneurs.
Okay. Good morning, good afternoon, and good evening. I'm Lisa Kleisner, and I'm pleased to co-present with Christian. So who are the impact intermediaries? Well, let's take a look. Next slide, please. So today we have really an amazing group of advisors who I would also say are very entrepreneurial as well. So Clara, Barby in the upper left-hand corner, I'm going to go basically, I'll point out where they are. So Clara, Barby, upper left, is partner and head of impact at Bridges Fund Management in the UK. Clara is also leading a global discussion on impact management, and she's going to share a little bit about that with us today. Jennifer Kenning is the CEO and co-founder of Align Impact in Santa Monica, California. Ivo Knurpfel in the lower left-hand corner is the founder and managing director of On Values Limited, a Zurich-based impact consulting firm. Neha Mudaliar holds the position of director at Unitas Capital in Bangalore, India. She's in the upper right corner. Annie Roberts is a founding partner of Open Capital Advisors, a management consulting and financial advisory firm that covers sub-Saharan Africa with offices in Nairobi, Kampala, and Lusaka. And lastly, Glenn Yelton is the head of impact research at SNW Asset Management in Seattle, Washington. SNW was recently acquired by Oppenheimer Funds. So next slide, please. Let's take a look at the demographics of the advisors who reported in on our study. So more than half of the advisors spotlighted in the report are from North America. A quarter of the participating advisors are from Europe, and the remaining 9% are evenly distributed between Africa, Asia Pacific, and the Middle East. So I would say one of the observations we have here is that there needs to be a lot of work done to begin to increase the number of advisories outside of the US. And we also see an appetite from investors through our Toniic community that are demanding more services and products in that area as well. Next slide, please. So, so what are the demographics of the advisors themselves? Well, 1/3 of the participating advisors in this report are women, which is unusual because in the financial industry, women are basically, they represent about 10 to 12% of the advisors in the financial services world. So it's interesting to see that women are stepping up in the impact world and having success. And the fact that they're participating with the 100% initiative is also exciting for us. 2/3 or more of the advisors have 5 or more years of experience. And if you have more than 30 years of experience in SRI, ESG, and impact investing. So what we see is that folks who started with SRI and ESG, they're bootstrapping and moving quickly into impact investing as well. Next slide, please. So one other observation we had from the firms reporting in is that the impact focus is interesting to observe in the smaller firms. So the smaller the firm, the higher the commitment to impact services. Smaller firms were also nimbler, providing bespoke services more readily than their large firm peers. Next slide, please. And our respondents are not doing this work alone. They are collaborating with investment, philanthropic, and wealth advisors to address the diverse needs of their clients. And so partnering, having key partners is really critical to the success of the individual firms. Next slide, please. However, none of this is happening without challenges. So while challenges abound, the advisors were across the board optimistic that they could be solved. So let's take a look at what some of those are. Next slide, please. So this is quite a list, but we're going to just focus on a couple. So the top challenges are basically overcoming myths regarding financial performance. And we're going to talk a little bit more about financial performance as we get into the webinar. The second one down is finding quality investments. That remains still a challenge to find an investment that aligns with the impact requirements of the client. And then also the continuing lack of exits. And also a little bit further down is the complicated impact measurement methods. And we're going to dive in to that because you, the viewers, quite a few of you asked to explore that a little bit more. So let's move to the next slide. So impact measurement, as we discovered in the report, remains a work in progress. However, what we saw is it is an industry priority. Next slide, please. Almost 90% of the respondents, and that would be the first two bars, are measuring now and or have plans to start. However, with the methodologies and tools in a state of flux, what steps are some advisories taking to close this tool gap? Next slide, please. So now we're going to bring in our speakers, and one of our speakers has not logged in yet, and that's Clara. So I'm going to skip to.
Oh, Clara is here.
Go ahead and, oh, she is. Oh, great. Yes. Wonderful. Welcome, Clara.
Hi, everyone.
Okay. So, could you put up the first question, please, and the second question? So, Clara, you're working on what I like to call an intergalactic process of looking at impact management / measurement with a lot of stakeholders across different sectors globally. Could you share a little bit with us about what you're seeing in the state of impact management, and also the big question, can impact actually be measured meaningfully across asset classes?
Yes, absolutely. So what Lisa's referring to is this project that's been going on among over 700 organizations to try and say, do we have a shared understanding of what impact even is before we talk about whether we have a shared understanding of how to measure it and manage it? And while that might seem very obvious, it hasn't necessarily been so. And we wanted to make sure that we were involving not just impact investors, but also social scientists, development experts, large mainstream asset managers who haven't allocated to impact yet, etc., to really make sure we were coming up with a shared understanding of what impact is that would resonate with many different people. We also involved heavily in the process the people whose lives are actually changing when they experience impact. Try and make sure that the way in which we think about it and frame it in our various industries and disciplines is really rooted in what is your lived experience of it, because obviously that's when you'll get really meaningful measurement and management. So the summary version is that there has been agreement that we should think of impact in terms of 5 dimensions. What outcome is the effect related to? How much of it occurs? Who does it occur for? What contribution does it make to what's already happening or likely to happen? And what's the risk that it's different from what you expect? So those 5 dimensions of what, how much, who, contribution, and risk, you can think of as an analog to dimensions of financial performance, like return, liquidity, volatility, etc. There are a number of dimensions of financial performance that, regardless of who you are, we're always trying to understand each other's appetite for when we set our goals, and we're always trying to identify when we look at performance. And we're looking at exactly the same on the impact side. It's been a really healthy process, not without its challenges at times. People had different languages and different disciplines, but those very basic words, that very basic framing is something that everyone's been able to agree on. Now, I mentioned that in answer to your question of what is the state of impact management, Lisa, because one of the most interesting things that's happened, and this relates to your second question as well, is that it has debunked the myth, I think, that impact investors have impact, and then all these other kinds of investment styles that have different labels to them don't have impact. There's been agreement that all investments, because all businesses, have impact, and it can be positive or negative. And the important question is, do we understand what those impacts are, and can we therefore manage them, which means preventing the bad things, the negative impacts, and improving the positive impacts. And so impact management at the moment, I would argue, is a slight reframing of the measurement question, but it's trying to say, we have historically been wrestling with impact measurement, trying to understand which metrics we should all be collecting. And now what we want to do is make sure that we start thinking about measurement only because it's going to help us make decisions to learn and improve. And what that means in practice is that we will see, I think, a shift away from collection of, if I just give an example and make this very real, collection of individual metrics like, number of lives touched or number of jobs created, which, we see particularly like jobs created, you'll often see in an annual impact report. It's really hard to manage with that metric, to actually learn and improve with it. Because usually what will happen is if you're collecting a data point like that across a portfolio of different investments, you're going to have jobs of very different quality, of very different demographics, which last for very different amounts of time, which are rolling up into that single metric. So you really can't tell which investments are performing well or badly when you use that kind of data point. So I think what we're seeing is a shift away from measurement for measurement's sake to what kind of measurement will really help us learn and improve, which is the practice of impact management.
Thank you, Clara. We're going to move to the next set of questions. Glenn, so can impact be achieved in the secondary market, and should we be concerned about conflation of ESG and impact investing? Glenn, could you give us your thoughts on this?
All right, thank you, Lisa. And that's actually a good question. It's a question that we face very frequently from our clients, whether we can in fact achieve that type of direct impact through the secondary market. S&W we are primarily an investment grade fixed income shop, so we are probably 60% to 70% of our investments are in the secondary market. What I want to, if you step back a little bit, though, Clara actually hit a good example, some good background data as it relates to measuring impact itself. That definition of metrics related to impact measurement is part of the overall conversation, and it ties into the ESG integration component too. If you look at this industry from a historical perspective over the past 2 decades, we've moved from the exclusionary socially responsible investing model to ESG evaluation, ESG integration, and now more into the impact investing. And that's not a product of evolution of investors, that's a product of evolution of data, of the metrics that are available, the data points that are available, and the actionable information that we have that can then lead into portfolio creation. So what we're finding when we talk to clients about the secondary market is you don't have a lot of direct impact on the secondary market, but what you do is you support the primary market. You, particularly in thematic investments, you indicate that there is a demand for an environmentally focused type of portfolio, for human rights focus, for gender equity, education improvement, healthcare, et cetera. And by proving that in the secondary market, it leads to opportunities in the primary market. A good concrete example of that is actually in the green bond market, where when you're looking at green bonds in the secondary market, they're trading at a premium these days. And they're trading at a premium because investors want to use that to align their overall portfolio to ensure that they are not doing harm first, and then actually achieving impact second. And Clara hit the nail on the head. Every investment that you do has an impact. There's a negative or a positive impact, and it is there's a spectrum. Ensuring that you work towards the positive end of the spectrum, both the secondary and the primary investments, is a key part of managing this type of portfolio.
Thank you so much, Glenn. And I am going to now hand this over to Kristen. And by the way, those who are in the audience, if you have further questions, if this has triggered a few more questions on your side, please go ahead and start filling in the Q&A box, and we'll grab those for the speakers during the last 20 minutes. So Kristen, next section.
Yeah. Thank you, Lisa. So yeah, let's actually turn to one of the more frequently asked questions. It's actually about financial returns. Advisors and investors share in our report that their returns are on target for them. Overwhelmingly, advisors' clients are seeking market rate returns. And 1/3 of the advisors shared that clients are also seeking sub-market rate options, as well as investments that achieve capital preservation. But actually, let's turn again to our expert advisors. I'll turn to Ivo first. So where can actually clients find more evidence, data, case studies, and actually portfolios examples for impact investing? Ivo, if you might.
Good day to all participants. I think an excellent source is the guide to impact investing that my colleague Giulia Ballandina has published about half a year ago, which shows a broad range of actual portfolios, including their financial performance and also their impact characteristics across different regions of the world. Of course, we're all excited about T100, the directory and the impact portfolio tool, which I think will also be an important source of such evidence. By the way, if you want to get access to the guide to impact investing, you can just access it through guidetoimpactinvesting.net over the internet.
Thank you very much, Ivo. These are great suggestions. And Neha, for you in India, what would you recommend to advisors and investors where they can find more evidence?
Hello everyone. And this is again a question which keeps getting asked to us as well, in terms of what is the evidence that impact investing can actually generate good returns and market returns. And so, to address this, we recently published an exit report where we analyzed 32 exits which we facilitated for 24 investments. And what we found really resonated with our theory that investors on and median, I'm not talking about the range. This is really the median, made 6.5 times multiple of their as an exit multiple of their investment. That translated into an IRR of about 41%. This was across 4 different sectors, including agriculture, healthcare, financial institutions, and education. Agreed that this is a limited data set, and of course there is some bias in terms of companies which where you can get an exit are typically companies which are performing pretty well. But it does go to show that you can not only get market returns but superior returns, given the kind of really vast market opportunity which is really untapped by a number of commercial investors today. And so I think that is something, again, the exit report is available on our website, United Capital. I think some other examples which you can look at, specifically in the Asian market, are some of the funds like Elevar, Avishkar, Lok, who've been very active in the India and some broadly Asia market. Where if you look at the fund size, Lok's first fund was about 13.5 million, and now their latest fund, in a matter of 5 years from the launch of their first fund, is 155 million USD. So we're definitely seeing a lot of resources being pooled in, and that is also translating. And the reason that they are able to raise such large amounts of capital is because most of their previous funds have given above market returns, including Elevar, which was earlier United Equity Fund. Where their first fund, which was a $25 million fund, has again returned more than 20% IRR to investors. And now the latest fund, they're in the fundraising mode, but the fund before that was a 74 million fund. So more than 3 times the first fund size. So there is definitely ample evidence available. There are case studies with regard to impact investing kind of really growing exponentially and delivering good returns.
Thank you very much, Neha. These are great results and that are documented. So, but one more question actually on the financial return side. What am I actually giving up in exchange for investing in impact? Or is there actually a trade-off between financial returns and impact? Maybe Glenn, you can give us some insights on that.
Yeah, for the clients that we work with, there actually has not been a trade-off. We're finding that we're able to create market rate returns and actually outpace our benchmarks by still applying impact criteria in the investment decision-making process. It's a matter of identifying the investment quality, identifying those opportunities that have the return potential for the clients that are appropriate with their risk tolerance. Again, we're not seeing any sort of sacrifice of return in the impact investing strategies that we're implementing for clients.
Great. Thank you. I'm going to pick it up. So Kristen and I are going to switch off on each of the questions. So I'm just going to jump in here. So next slide. So in order to serve this market and the demand coming from clients, there's been a need for these firms, both small, medium, and large, to develop a pretty wide berth of services. And those services and products have to be deep. So we queried about what the status was there, and you can see that the top 4 services are impact strategy advice, impact policy development, asset management, and impact due diligence. But those are not the only services being provided. And so some are providing a full net of services, including impact reporting as well as philanthropic advice. Next slide, please. So regarding asset classes, most firms are advising on product solutions across asset classes, while a few firms are specializing in 3 to 4 asset classes. For instance, we had a couple firms that were looking only at fixed income, and the public markets, and some that didn't look at private equity at all. Next slide, please. So impact categories, for those unfamiliar with impact categories, the way we look at the world on the impact side is thematic would be where you really have a targeted impact that you're going after. Particularly, let's say you pick up gender lens, or let's say that you're looking at climate change. Sustainable and responsible would be screened funds on the negative and the positive side. And then of course, most folks have non-impact that they're working toward finding the right impact product for. But as you can see, interestingly enough, thematic is leading. And what we see also with our 100%ers is that thematic is the overwhelming type of category, impact category that's in their portfolios, with sustainable and responsible being less than 30% of their portfolios. Next slide, please. And then within the impact categories, the themes that we're seeing, the top themes are environment, sustainability, and cross-sectorial. Cross-sectorial, by the way, would be where an investment has multiple impacts that it's targeting. Next slide, please. So now we're going to take a look at the question around how do you build a viable impact practice? And we have such a diversity on the line today. Every one of our speakers has built a unique and different practice, and we won't be able to cover that with everyone, but we're going to give it a good try here. So we're going to start with Ivo. Ivo has an impact consultancy in Zurich, and of course, everyone on the line is dealing with different regulatory hurdles within their own region. And so, Ivo, why don't you share with us what's key, at least for you, to build a viable practice?
Yeah, I found that key is to be absolutely clear and transparent with regard to your business model. So advisors is a very broad term, but there's many different types of advisory businesses. One of them is providing investment consulting services only, and doing that exclusively for asset owners. That's the model that we chose at On Values 15 years ago. Then, of course, there's the asset management model. This is a great model because it gives you a certain financial stability over time. It allows you to grow. And maybe a third business model is actually managing and distributing investment products. Again, all these different models have their place in the spectrum. We chose the investment consulting model because we wanted to be able to advise asset owners on their total wealth strategy. And our experience was that if we started to provide asset management services or products, typically the wealth holders would treat us as just a provider of asset management and not as a trusted advisor overseeing their total wealth. Another important challenge is we don't believe in impact advising as a standalone service. So we believe it needs to actually be integrated in sound financial management and financial and investment consulting. So a viable practice is one that is able to attract and retain professionals who can actually integrate impact in financial and investment experience. And this is, not easy to find those individuals. On top of that, because we are a consulting business, the advisors that work for us also need to have very strong consulting skills. So yeah, that's for us viability, to find the right people.
So it's all about the people, just like it is with the investments and the investees. So next question, please. So this question is for Annie. What is the demand for and what are the successful business models in emerging markets? And I think you're uniquely qualified to answer this question.
Yeah, absolutely. And Thank you all for having us today and for listening into the webinar. This is a great presentation and a great group of folks to be able to participate with. So thank you all. I think to Ivo's point, it really is, there are a variety of different business models that an impact advisory can run. I think in emerging markets, it's increasingly important to actually diversify that. So from the perspective that we've taken at Open Capital, where we've now grown to 55 full-time staff in 3 offices in Sub-Saharan Africa, is that we need to be able to both provide support to the impact businesses themselves, because one of the key challenges is sort of finding investment-ready companies when it comes to impact businesses, and to the investors. So we're obviously very careful about conflict, but our business model is diversified so that we can both provide support directly to companies as they're looking to raise impact capital, and to impact investors as they're thinking about where they can place their capital. So we offer due diligence services and impact management services as well. We also work with a variety of different development partners, and that allows us to provide a lot of insights across our different client types. So the work that some of the development partners are doing to try to catalyze more private sector investment and more impact investment allows us to inform some of our impact businesses on the successful business models that they're looking to start funding and scaling. And so I think that, at the same time, providing support to a lot of the entrepreneurs as we do allows us to inform sort of these development partners on how they should be operating their strategies as well.
Thank you. I'm looking at the time, and so I think we're going to need to move beyond. I'm going to move it to the last question for Glenn. There we go, Glenn. Any interesting stories on mergers and acquisitions?
Well, we just got acquired by Oppenheimer Funds a few months ago, so I consider that a pretty interesting merger and acquisition story. We were not acquired because of the impact model, but we were acquired because of the overall service model we're providing. In addition, however, you've seen Goldman Sachs acquire Imprint Capital just a few years ago. You've seen some of the smaller boutique firms creating partnerships with larger advisory firms and asset managers to provide this service as an adjunct to the primary financial management services that are provided. So it's an emerging area of M&A. Hopefully we won't lose any of our spirit as that sort of change happens.
Yes, good point. And I do want to just, if I could do it real briefly, maybe in just one sentence, Neha and Annie, what's needed to stimulate the development of impact intermediaries in Asia and Africa? So Neha, do you have one thought there?
Yeah, I think as investors, it's a demand and supply thing. So I think as investors focus more on these geographies, I think we will see a lot more intermediaries coming up. I think it will also be where the kind of management which investors want to do. So, whether they want to have a presence on the ground, and whether they want to have intermediaries who have very strong knowledge of the regulations and the challenges on the ground. So I think
so it's all about client demand, pretty much.
Right.
The clients gotta want it. Okay. Yeah.
Right.
So Annie?
I think that's right. I think it's about impact investors actually wanting to work with international providers if they're looking to place their impact portfolios abroad.
Yeah, and I would have to say that we saw that in the report, that if the clients are basically creating the market, and so in geographies where we're not seeing intermediaries, then folks who are interested in moving the dial forward need to coalesce investors to step up and demand those services. And then I think you're going to start to see that development, just as we saw it in the US. So next slide, please. And yes. I'm going to hand this back over to Kristen.
Perfect segue. Actually, what we see is definitely client demand is driving the sector. And as mentioned earlier, all advisors surveyed expect growth, with actually 1/3 of them expecting significant growth in the next 3 years in their advisory. And as seen on the next slide, impact investing is actually no longer solely the domain of individual private investors, but rather a growing number of foundations, family offices, endowments, and institutions are seeking to bring impact into their portfolios. And 60% of the advisors' clients are in impact are actually women. So, and as demonstrated on the next slide, impact investing is also no longer solely the domain of double and triple digit million asset owners, but advisors are serving a broad spectrum of asset sizes and finding products to suit their client impact appetites for all of them. So I will combine the next 2 questions in terms of time and would like to direct that to Jen So how are you actually managing the range of impact needs, and how have the needs of your clients evolved over time? Let's see, Jen, are you here?
Yeah, I'm here.
Okay.
Hi, thank you for including me in today. So I think where they begin and where they are on their journey evolves significantly. One, from understanding the marketplace, and then two, from the diversity and the opportunities, not only amongst products, services, as well as managers, but as they dive in, they actually see this is more complicated than maybe what they first thought when they began. And as they move through their journey, they actually get to be more involved in the issue areas and the sectors and themes that they're focused on, which then drives a level of complication that allows for the intermediary to really help guide them on their journey. I'd also say that when you begin, you have a certain expectation of, I'm trying to do this in phases, right? I'm going to take on one part of my portfolio and I'm going to gradually move across the portfolio over a period of time. So I think as they're building out their portfolios, whether it's from the philanthropic side all the way to 100% impact portfolio, those needs change. And we as advisors and intermediaries need to be able to go on that journey with them and then bring in the right people along that journey so that they can get the right expertise and solutions for what they're trying to accomplish.
Yes, wonderful. That's absolutely what we find. And what we actually also found is that mostly millennials and women are actually asking for the services. And with that, I would like to come to the next question, actually about what products and services do resonate most with these young millennials and women. And Ivo, I think you have some good examples to share here.
Yeah, well, it's always difficult to generalize, you know, actually you should not generalize, but we find millennials very interested in social venture investing. So they like to invest in startup companies, social ventures, taking also very hands-on kind of approach. Women are really interesting. I find women the most holistic type of investor. They actually look at the systems issues. So they're interested in environmental issues, climate change, development issues, social issues. And I find women often see the connections between these different themes. So often they are the ones who understand also total portfolio investing much quicker than their male counterparts. That's been our experience in the past 15 years.
Thank you. That's an interesting finding. With that, I hand it over to Lisa.
Actually, thank you. I actually had the same observation, not only in impact investing, but in a lot of the work we do in the ecosystem. There's a lot of women, and you know, today there's 4 on the call. So I think women have a huge opportunity to continue to provide leadership in the space, both on the investor and advisory side. So I'm going to run through, so just real quick, next slide, and thank you. So one of the things we picked up from the survey and from the interviews was that the advisors are feeling a lot of accomplishment about the work they're doing and a lot of optimism as milestones that they set for themselves are being achieved. Next slide, please. And this is just a small sampling of some of the feedback that we got in Ivo. You helped at least a dozen families move to a majority of 100% impact portfolio. That is a huge lift. And I know that you work with families who have very significant wealth. And so just real quickly, you know, that's a lot of work, but apparently when we asked you if it was an accomplishment, you said it with a lot of joy that this was a great part of the work that you do. So maybe you could just share with us your perspective on how the practice itself is actually feeding you and your needs as an advisor.
Well, I think that that's where it becomes really strategic, when you are able to work with your clients on their total wealth across all asset classes. And you know, in the liquid space, there is a huge choice of asset managers, products. I mean, you know, the SRI and sustainable investment industry has a 20-year track record or even more. So it is relatively easy for us through our databases and tools to actually fill the liquid space. The bigger part of the work, of course, is in the real asset and private equity impact, targeted impact. That's usually the smaller part of the wealth, but the one that requires most of our work. And it's one of the challenges we advisors face, the willingness of our clients to actually pay for good due diligence work on, you know, private equity and private debt investments, where the amounts are usually much smaller, but the work and the cost for advice is of course higher.
Well, that actually leads into a question that one of our viewers has asked, and this is from Auni. She says, he or she says, how do we go about decreasing transaction costs with so many bespoke conditions around our advising and consulting work and so little actual progress around standardization? Any thoughts there? Ivo?
Well, I think in a way, we as advisors, consultants, we are helping to standardize things. We are usually trying to group several clients around a piece of work. And so in a way, we are trying to increase the efficiency of the market. I know that also several banks are hosting platforms that allow clients to share due diligence work. And of course, Toniic and other platforms are also very much supporting the standardization work. I think this is crucial to improve the efficiency of the market and also scaling up of the market.
Jen, do you want to jump in here? Because I know that this is something that you've been challenged with and you've been working on a solution for your small firm.
Yes, thank you. So I think one of it is you have to develop process, and you have to really stick to that process as a firm and have clients be able to get a custom solution, but inside of a process. And so part of what we do at Align is work with the other trusted advisors for the clients. And we have to make sure that the fees on the overall investment portfolio work for the client, right? So we're more in a sub-advisory capacity, being able to complement the trusted advisor, and allowing us to share fees drives down the cost for the client. And so I think it's really trying to see what role do we play, or any intermediary advisor, and what value are we adding, and how do you do that in a way that you can do this in a manner that's equal or better to the traditional markets and not going to cost you twice as much to do so.
Mm-hmm. Thank you. So we've got, move to the next slide. We're going to actually hold on the keys to success and then go to the next one. And this is a quick question also for Neha, and this is new impact funds. A number of our viewers were asking, what do they need to do? What would be the top 3 things that they should have in place in order to attract impact capital?
Thanks. So I think it's going to be similar, in terms of traditional funds as well. I think first thing is you have to get a very good, fund manager with a good track record. You really have to have the second thing is you really have to have a clear differentiation in terms of, what is the existing landscape today in terms of impact funds, and what is the niche which you are creating in terms of the sectors which you're targeting, the geographies, also in terms of the stage of investment. So is it going to be early stage, seed stage, growth capital, and really why would an investor kind of invest in you versus some of these other funds, because it is surprisingly, and I guess really again going to show that the market has developed, that there are a number of funds which have launched recently and are looking to attract capital. So you really have to have a key differentiation there. I think the last most important thing is you have to have an anchor investor. In terms of really somebody who will stand by and commit at least 30 to 40% before you start raising funds from other investors. Finally, I think the last thing is you have to know what target investors are you, what category of investors are you targeting. So is it the family offices? Is it the foundations? Is it the DFIs? And what kind of investment horizons and what kind of return expectations do they have? And can your portfolio then deliver those? So, I think those are the key things. The last thing is, of course, helps if you've already identified some good companies or projects as pipelines, which you can then showcase when you're trying to attract capital.
Thank you so much. So it's rigor, rigor, and more rigor. Because it's a pretty competitive environment. So I'm going to go to the Q&A. We've got some really great questions. The first one is for Clara. So it's, what is the role of the external advisors in impact measurement and evaluation? And do you use external advisors for this? Do you use them often? And then the last part of that question is, which are the areas that you measure most? Is the impact measurement and evaluation market big and growing? So that's a big amount of things. Pick whatever you want to answer out of that.
Okay, the most important thing I want to say is that what's really interesting about impact measurement, when you're looking at measuring impact that is often very, very far away from where the asset owner is because we can't roll up impact data into a single number the way we can with financial performance. You are faced with the challenge that you really do need to make sure that everyone in the capital chain, ultimately to the frontline enterprise reaching the beneficiary, is collecting the same data and sharing it with each other. And the reason I mention that as context is that, to answer the question, is that when we think about helping folks measure their impact, because of that reality, you have to have a network of folks that you work with, because no advisor can advise both the asset owner, but also be the one that's actually collecting data at the front line with the enterprise from the people who are being affected, or vice versa. So we have found that idea of collaboration along the capital chain to get meaningful data to run along it incredibly important.
Thank you. The next question is for Ivo. And this is, does impact measurement have a significant share in an impact consulting company's revenue breakdown? And do you see a market for impact investing in general and impact measurement in particular in CE and SEE?
Yeah, well, it's at our company, it's really very integrated. So we do not offer it as a separate service. We offer basically consolidated reporting as a service, which includes both financial and impact data. We like to actually ask the asset managers and the advisors that are working on behalf of clients to provide impact data. We believe it's not something the client should pay for or should be segregated and managed by the client. We believe in integrating this kind of data into the system, into the asset management system. So the request is for the asset managers working on behalf of our clients to actually provide that data. We provide guidance in terms of the system of metrics. We refer to IRIS and other basically systems for impact metrics, but the work should actually be done by the people taking investment decisions, so the asset managers.
Thank you, Ivo. So the same question was posed to Annie, so maybe from a sub-Saharan perspective and a diverse practice perspective.
Absolutely. And I think in our practice, we don't actually manage funds. So we have a bit of a different perspective than Evo. So what we found is actually that some of our clients want to hire us for impact measurement, even outside of sort of the work that we might be doing with sort of the impact businesses or the investors that are placing capital into them. Though, to be honest with you, in terms of revenue, I don't think it's a very large share of what we do, mostly because I think, to Evo's point, it does need to be integrated into what's happening. And sort of our theory of impact measurement is really that a lot of the impact should be part of the business's core model. So they should be either reaching the mass market or doing some of those pieces of work. So the specific revenue that we have associated to impact measurement, I would say, is less than probably 5%. Most of the impact measurement that we do is alongside the sort of core growth of the business, meaning that the impact should be built into the fundamental business model that's being executed.
So there's another, I would say, more comment, and I'm just curious what your response to this would be. Ella says, there are a number of revenue-generating microfinance companies in sub-Saharan Africa, yet most impact investors will not invest in these companies with less than 10 million gross loan portfolio. I don't know if that's the world that you're working in, but yeah.
Yeah, I think where this question is going is that sometimes it can be challenging for impact investors to feel comfortable taking the higher level of risk that would be required. So for some of these microfinance companies with a much smaller loan portfolio, they tend to be a much earlier stage company themselves as the microfinance institution. And so for early stage businesses, we heard earlier from Glenn, from Neha, that maybe there's not a trade-off between impact investing and returns from a financial perspective. But I do think for some of these earlier stage, higher risk investments, like what some of these very small microfinance companies are doing, it may be a bit challenging in some instances, and that may be why some impact investors are a bit hesitant to try to place their capital into some of those earlier stage companies.
Thank you. So we have another question here from Dubril Saw, and it's about impact measurement again, but a little bit of a different twist. Carbon credit certification companies like Gold Standard are moving towards certifying SDGs impact. S&P is building a green rating for green bonds. What do you think of such new stakeholders in the impact investing space? And I'm going to just open that up for the first person that raises their hand who wants to address that. And if we don't get a raised hand, then I'm going to go after Glenn.
All right. Well, Lisa, I was actually going to volunteer for the second part of that question, which is the green bond work that S&P is doing. As I mentioned earlier, what I see with the 20 years I've spent in this industry has been this evolution of the data from exclusionary to the more the ESG, now the impact measurements. In parallel with that, we've seen the external standard bodies that have emerged that have sort of put their stamp of approval. And there are early entrants into the space. S&P is not an early entrant. They've got a bunch of history on this. But when we're looking at sort of the carbon certification side of it, some of these players are new. So we're going to have to see how it pans out. For us, looking at it from the fixed income, low risk side of the house, where S&W operates, we welcome this third-party certification. With green bonds in particular, we look at those external certifications by groups like Vigeo or Sustainalytics that Green Bond Principles encourages as a component of endorsement, if you will. In addition, we're seeing organizations like the Green Bond Principles and their new iteration of standards that came out just in late June, I believe it was. They've included the concept of social bonds in the standards that they're promoting. So they now have green bond, sustainable bond, and social bond standards that they're promulgating, and external certification bodies for those will emerge, and we welcome that.
Since I have you up, I'm going to ask you one more question. This is from an anonymous attendee, and this is regarding back to the secondary market. What are the benefits of, or what is the kind of impact investing that one can achieve by investing in the secondary market?
Well, again, that's the challenge, right? Is direct investment leads to direct impact. Direct investment leads to direct metrics that you can measure as an ongoing outcome. If you are an initial investor in X company that has an impact mandate, you can track the evolution and progress of that investment over time and the performance associated with that. The secondary market, you've stepped away from that. You're now buying from other actors who were those initial participants, and it's sort of watered down. But it is part of an overall impact integration. Ivo hit this whenever he's talking about working with the families. When you're integrating across all asset classes, actually I think Jen may have hit this too. When you're across all asset classes and you're moving towards a 100% impact portfolio, there will be a range of impact that's achieved in different asset classes. and in different points in portfolio progress for that particular investor. So secondary market is in a reasonably diversified, managed from a fiduciary standpoint portfolio. You are going to have secondary market investments. They should have positive impacts. Those impacts should align with your overall mandate and your overall impact outcome that you're seeking to achieve. They're going to be less, they're going to be mitigated because they are in the secondary market, but there's still, you've got to keep them in consideration.
I would say that the divest invest, oops, I'm having a little bit of backfeed. The divest invest movement has shown that investors can have impacts in the secondary market. And I also think scale is something that you can achieve in the secondary market that's difficult to achieve in the private equity market. So I'm going to ask a question this time for Jen, and that is, this question is from Mark, and that's, how have you dealt with the challenge of inadequate options in each asset class?
Great question. So you have to really be clear with the clients when they're asking in certain asset classes where we just don't have products yet, that we're going to get there over time, and that you're not going to just put something in that asset class just to fill the asset class. And so we really try to educate our clients that this is a process, right? We're not going to have defensive strategies or certain hedging products yet in the impact world that we feel are going to meet the rigor and the standard and the financial expectations that we need, as well as the impact metrics. And so I think, you know, if you think about where we're going as a market, we will get there over time. Rome wasn't built in a day. And so I think it really goes back to, are you trying to get to 100% impact portfolio, or are you trying to get there as well as achieve the returns you're seeking?
Thank you. So
can I add, Lisa?
Yes, jump in, Ivo.
It's very important to have discussions with the client. We have that regularly about the impact of asset classes, not just single investments. And clients understand that certain types of investments in commodities can have disruptive effects on the agricultural markets, for example. Or they start understanding that physical gold is a huge challenge. You cannot really source sustainable physical gold. Or they start understanding how the hedge fund industry works, and they ultimately decide that from an impact point of view, they want to avoid altogether the hedge fund asset class. So I think that kind of discussion at the asset class level from an impact point of view is really interesting for clients to have.
Thank you. So we are within 2 minutes of the end of the hour. And so I wanted to thank each of you and just ask if you had a last word here. So I'm going to start with Annie. Just maybe a last piece of advice for our audience.
Yeah, no, thank you all for joining. I think the only piece of advice I would say is, you know, try to find the right impact advisory that will help you achieve your impact goals. So if your impact goals are in emerging markets, we'd love to see more of you active here.
And then I'll move to, thank you. I'll move to Jen Kenny.
I would say really be, recognize that the problems we're trying to solve are huge, and we can't be dogmatic in our approach.
Thank you. Neha?
Yeah, I think, you know, look at diversity in terms of your product. So look at equity, look at debt, look at sub-debt, because, you know, if you're looking at a social enterprise, there are wide kind of needs which they have, which cannot necessarily be achieved only with, you know, pure equity investments. So kind of be more innovative in some of the structures which you look at, and also look at diversity across geographies and sectors.
Great comment. Glenn?
Well, I'm actually going to say celebrate. We should celebrate as we move forward with impact. Every time we get new asset classes that have an impact option, that's an awesome victory. Every time we have a family that transitions to 100% impact, awesome victory. Let's celebrate as we move along and keep the journey going.
Thank you. I'm celebrating already. And see who, and Ivo, you're the last. Well, actually, you're not last. Clara is going to be last. So you're second to last.
Okay. I would invite clients to really see the value of independent advice. I really think that it can add both financial and impact value. And if clients compare the cost of this advice with the often huge costs that they are paying in the other parts of the investment management and asset management, then I think it's worthwhile looking at independent advice.
I agree. And actually, Clara had to leave, so you are, in fact, the last word on this. So thank you, all of you, for taking the time, both in the audience who stayed the course for this very interesting conversation, and to our speakers who are really kind of my personal heroes, because they are really pushing the envelope around the world on impact and for a better world for all of us and for our children. So thank you for joining us today, and have a great, wonderful rest of your day, wherever you are. Goodbye.